something went terribly wrong, and almost no one noticed. It didn't start with a crash. There were no alarms, no breaking news, no red flashing warnings. Just numbers, quiet, cold numbers, moving across screens in banks, in governments, in places most people will never see. Every country in the world was borrowing, trillions upon trillions, year after year. Debt stacked on debt, layered so deeply that no one could remember where it all began. And yet the system didn't collapse, because behind every debt, there was a creditor. Or at least, that's what everyone believed. But what if the creditors weren't who we thought they were? What if the world wasn't just in debt, but trapped inside something far bigger? At first glance, the system looks simple. A government needs money, it issues bonds. Investors buy those bonds. The government promises to pay back with interest. Clean, logical, stable. But the deeper you go, the more the lines begin to blur. Because those investors aren't just people. They're funds. Massive, invisible pools of capital controlling unimaginable wealth. Pension funds managing life savings. Insurance companies betting on the future. And then there are the central banks, the silent giants. They don't just participate in the system. They shape it. When economies slow down, they step in. They buy government bonds in massive quantities. They inject liquidity. They keep everything moving. But here's where the first crack appears. When a central bank buys government debt, who does the government actually owe? Because the central bank isn't just another investor. It's part of the system itself. It's like borrowing money from yourself. For decades, the system expanded. Debt wasn't seen as danger. It was seen as growth. More debt meant more spending. Until something strange started happening. Countries weren't just borrowing to grow. They were borrowing to survive. Entire economies depended on continuous borrowing. Old debt was repaid with new debt, not because it was strategic, but because it had to be. To understand it, you have to follow the money, not just where it goes, but where it comes from. Because here's the uncomfortable truth. Most money in the world is created from debt. When banks issue loans, they create new money out of nothing. Think about that. If money is created through debt, then paying off all debt would mean destroying the money supply itself. The system isn't just dependent on debt. It requires it. And that's when the question becomes dangerous. Who is the real creditor? The real creditor is the system. A system designed to expand, to grow, to demand more borrowing, more lending, more movement. For years, this system operated quietly. But then came the first real warning. Not a collapse, but a tremor. A moment when markets froze. Trust disappeared. Suddenly, institutions that were considered untouchable began to fall. Not because they lacked assets, but because they lacked liquidity. It didn't make sense. Until it did. Because in a system built on debt, confidence is everything. The moment confidence breaks, the system breaks. Central banks reacted instantly. They flooded the system with liquidity. Trillions were created, and the collapse was avoided, but at a cost. Because every time the system is saved, it becomes more fragile, more dependent, more stretched, and that's where we are now. Governments owe trillions. Central banks hold massive portions of that debt. Financial institutions are deeply interconnected, and money itself exists because of borrowing. Imagine a web. At the center is nothing, just a network of obligations, country to bank, bank to fund, a loop, a closed circuit, where everyone owes and everyone is owed. But the system only works as long as the loop continues, as long as money keeps moving, as long as debt keeps expanding. Now imagine what happens if it stops. Slowly, a decline in borrowing, a tightening of credit, a loss of confidence, connection strain, pressure builds. The system isn't designed to shrink, it's designed to grow, and that's the real danger. Countries can never fully get out of it. Some countries have tried. They cut spending, reduced borrowing, paid down debt. It seemed responsible, but the results were unexpected. Economic growth slowed, unemployment rose, demand weakened. Because less debt meant less money flowing, so they reversed course, borrowed again, kept the system alive. And then there's the final layer, the one most people never see: derivatives, financial instruments built on top of debt, a shadow system, where the value of contracts exceeds global GDP. These aren't just side bets. If one part fails, the effects ripple outward, fast, uncontrollable. And yet the system continues, growing, expanding, stabilized by trust, held together by belief that the debt will be repaid, that the system will hold. But what happens When that belief starts to crack, every system that depends on endless growth eventually reaches a limit. The shift isn't gradual, it's sudden. Right now, everything appears stable, but beneath it all, the pressure is building, and somewhere inside that system, a question is waiting, quiet, unanswered. If everyone is in debt, and the system itself is the creditor, then what happens when the system demands payment? Part 2. The question didn't arrive with noise. It didn't break through headlines. It moved quietly, through balance sheets, through bond markets, decisions made behind closed doors. At first, it looked like a routine shift. Interest rates began to rise, slowly, carefully, deliberately. For years, money had been cheap, almost free. Borrowing was easy. Debt expanded without resistance. Governments rolled over obligations effortlessly. Markets thrived on liquidity. And then, the cost of money changed. Not dramatically, just enough. Enough to expose something hidden for decades. When rates rise, debt becomes heavy. At first, the impact was subtle. Governments noticed their payments increasing. Corporations began to feel pressure. Loans started tightening margins. Consumers slowed down. Still, the system held. But this time, something was different. The world wasn't carrying the same level of debt. It was carrying far more, unimaginably more. Debt built during years of low rates. Debt that assumed money would remain cheap forever. But it was changing. The system began to react. Not collapse. React. Bond markets shifted first. Prices fell as yields rose. Investors demanded higher returns for risk. Existing debt, issued at lower rates, was suddenly less valuable. Trillions began losing value. Trillions in assets began losing value, not because they were failing, but because the environment changed. And then came the second wave. Refinancing. New debt came with higher interest. Each rollover increased the burden. By necessity, the loop was still intact, but tightening. Central banks watched. Now they faced a contradiction. To fight inflation, they had to raise rates. But raising rates stressed the very system they protected. It was no longer a balancing act. It was a dilemma. Low rates meant inflation. High rates meant debt unmanageable. And that's when the fractures began to appear. In specific places, weak points, a country struggling to service its debt, a financial institution overexposed to interest rate shifts, isolated, containable. But the system wasn't built on isolation. It was built on connection. And connections transmit pressure. When one part tightens, others feel it. When one part weakens, others compensate. Until they can't. Liquidity began to thin. Markets once effortless started showing resistance. Buyers became cautious. Sellers became urgent. Spreads widened. Confidence narrowed. And still, no collapse. Intervention. Central banks stepped in again. Not loudly, but precisely. Targeted actions, emergency facilities, quiet support mechanisms designed to stabilize specific areas without shaking the entire structure. It worked, for a time. But each intervention carried a cost. Every rescue reinforced the same underlying truth. The system could not sustain itself without support. And that realization began to spread internally. Among institutions, among decision-makers, among those who understood how deep the dependencies ran. The system wasn't just interconnected, it was dependent on continuous borrowing, on continuous confidence, on continuous belief that the loop would never break. But belief is fragile, and once questioned, it doesn't return the same. Investors began to shift behavior, subtly at first, preferring shorter-term assets, demanding higher returns, avoiding certain risks once acceptable. These weren't dramatic moves, but they changed the rhythm of the system, and the system relies on rhythm. Governments felt it next. Auctions once filled easily required higher incentives. Debt issuance became more expensive. Budget pressures intensified. And then came the quiet realization, not announced, not declared, but understood. The system wasn't approaching a single breaking point. It was approaching multiple pressure points simultaneously. No single moment, no clear line between stability and collapse. Just a series of stresses, building, layering, compounding. And then, something shifted. Not a crash, not a failure, a hesitation, a moment where the system didn't respond as expected, where liquidity didn't immediately return, where intervention didn't instantly stabilize. It passed, quickly, But it left something behind. A question. What if next time it doesn't pass? Because the system had reached a scale where small disruptions carried massive implications, where confidence was everything, and confidence doesn't break all at once. It erodes, slowly, then suddenly. The world continued. Markets opened, trades executed, governments borrowed, payments were made. From the outside, nothing had changed. But beneath the surface, everything had. Because now, the question wasn't theoretical anymore. It was real. If everyone is in debt, and the system itself is the creditor, then who absorbs the loss? Not a country, not a bank, not a single institution. The system absorbs it through inflation, through currency shifts, through asset repricing, through silent adjustments that redistribute the cost across everyone. No announcements, no clear events, just a gradual transfer. And that's how the system survives, not by avoiding failure, but by spreading it so wide that it becomes invisible. But spreading pressure doesn't eliminate it. It delays it, transforms it. And over time, that pressure accumulates because the system still depends on one thing it cannot guarantee: endless growth, more borrowing, more lending, more expansion. But growth has limits, not immediate, not obvious, but real. And when those limits are reached, the system doesn't ask for permission, it adjusts. The question is, how? A slow restructuring, a prolonged period of stagnation, an inflationary reset that erodes the real value of debt, or something sharper, faster, less controlled? No one knows, because no system of this scale has existed. This isn't a repeat of history, it's something new. A global network where debt creates money, money sustains economies, economies depend on growth, and growth depends on more debt. A loop, self-reinforcing, self-expanding, until it isn't. And somewhere, quietly, beneath all the data, all the movement, all the complexity, that same question remains, unresolved, unanswered. Not who the creditor is, but what happens when the system can no longer hold itself. Because when that moment comes, it won't begin with a headline. It won't announce itself. It will start the same way everything else did, quietly, with numbers, moving across screens, until one day, they stop behaving. And when that happens, the world won't be asking who the creditor is. It will already know, and it won't matter anymore. Who? Gold pays. For war. Who really pays for the system? We do.